property back a year ago in the Tipper Hill in Syracuse, 48 unit complex. It's our first large multifamily we purchased. That's been going well through COVID. Actually, we closed and COVID hit, and it was kind of like the eye opener that stuff does hit the fan pretty quick when you buy your first property. Can't expect it, but something will. And we got COVID, so it was very interesting and learned a lot, and we worked through it. But it's been going great. And I think we've done a lot better than we actually thought we could, and it's turned out great. So shortly after that, we decided to do more, and Jamie and myself known each other for a little while, and decided to kind of talk a little more about joining his partnership. So there's the four of us that are working now: Jamie, Chris, and Gary, and myself. We're looking at for bigger and better properties here in upstate New York, and probably down in the South, like the Carolinas next after that. So it's a quick one on me for you guys.
Awesome. Thanks, John. Gary, you're up.
I just did what John just said. So yeah, I've been
perfect. All right.
Doing
awesome.
Multifamily for a while. Started selling off some of my duplexes last year. So trying to make way for bigger investments into commercial properties. So we're storming, trying to get some deals. Four of us have gotten together, and we're just really starting to hit the road here and see what we can drum up as far as 2021 goes. Yeah, looking forward to a great year and some great opportunities hopefully come our way.
Certainly. Thanks, Gary. David.
Yeah, I started single family rentals about 1998, in and out. We purchased our first multifamily back in 2013, a small 5-unit with storage units, some garages. We just closed on an 11-unit beginning of December. Working on a 99 unit. I would flip some information to Gary, and then also looking at a 19 and a 48. So hopefully be able to bring something to you guys.
Great. Thanks, Dave. Really appreciate it. And looking forward to seeing that stuff. Thanks for joining us. Chris.
Yeah, so my story is kind of similar to you, Jamie. Been doing this for a few years now. I went into the the 4 families, started over in like the Tip Hill area, which is kind of really popular for like the younger kids coming out of college. And then slowly kind of graduated to like the 5 units, the 6 units, and then total. And right now we have 25 units, and just kind of looking to get into some bigger stuff. So I met Jamie, I think 2 years ago or so, whatever it was when you started this group, and kind of had similar goals. So we teamed up with us, John and Gary, and looking to take down some bigger stuff.
Awesome. Thanks for joining, buddy. Appreciate it. Dominic.
Hey, so can everyone hear me?
Yeah.
Yes.
Beautiful. Sounds good. So Dominic Manfredo, full-time. I'm actually Chief Executive Officer of a senior housing company in New Hartford, New York. But instead of just making our company get bigger and grow, I'm also looking for my own personal portfolio. First thing I did was 5 years ago, I house hacked my first duplex. Nowadays, I realize that the demand for duplexes in the smaller units, there's too much competition, prices are going up, cash flow is down. So I'm really looking into the bigger style units in the commercial end and in the residential end. I was looking for 24 and above to get into my own personal portfolio. I'm looking right now at a 68 unit and another one that is 30 units, all within our area. So I'm looking to partner up with other people and network and see what everyone else is doing.
Great, man. Thanks. I really appreciate you jumping. Yeah, definitely. Yeah. Well, really appreciate you jumping on and sharing your experience, and hope we can help you out.
Yeah, it'd be great. Thank you, everyone.
Yeah. Jay, how you doing, bud?
Hi, guys. Yeah, just like Dominic, I started off, I house hacked a duplex, and that was about 15 years ago. Still have it, and now I'm just looking to get into bigger multifamily.
Great. Thanks. Awesome, man. Appreciate it. Thanks for joining. Stephen.
Hi, Steve Episcopo. I am relatively new at this. I have one single family home, but I have a 6-unit apartment building under contract right now locally. And am just looking to learn. It wasn't my plan. I didn't think I was qualified enough for bigger properties like that, but it just kind of fell into my lap. So trying to make that work, and realize that it seems a better path to go. So
yeah, that's great.
Amen.
Yeah, totally. You gotta start somewhere, and it's great when when they say, "Yeah, you're accepted." It's like, yes. Awesome. Thanks for jumping on, Stan.
Yeah, I'm Stan Matus, and I guess I started investing in duplexes, triplexes, and quads 15 years ago or more. And just in the last few years, I've tried to migrate up to larger units. We got a 12 and a 11 unit last year, but would like to migrate to larger complexes, and excited to connect with you guys.
Awesome. Thanks. Really appreciate you jumping on. I think the last one here, Matthew.
Hey, how's it going? Sorry. Yeah, so I actually bought my first San Francisco single family home when I was 24, and I bought my first multi-unit in San Francisco when I was 29. And now at 38, I just bought another property, but I am looking to syndicate deals now.
Awesome. Very cool. Awesome. Are you looking to syndicate in your area or just anywhere? Or
looking to syndicate out of state.
Okay.
And working with some mentors and trying to get our first deal funded this year.
Awesome. Great, man. Thanks for joining us. Really appreciate it. Everybody, I appreciate you jumping on. If you guys want to, and you want to throw just your contact info in here, feel free. I appreciate reaching out to people in any way, shape, or form. So Zoom obviously is the preferred method at the moment, but it won't be forever. So if you ever want to reach out to me and grab a drink or coffee, whatever, lunch, by all means. Hopefully we will be able to do that sooner than later. But yeah, so we started this group really as from two perspectives. We wanted to help educate people, but we also wanted to show people kind of what we are going through, what we are seeing, what are we underwriting and why, and also to bring on people like John Fortes, who can kind of shed some light on the path he did to getting from IT consultant to now a successful syndicator. So I look forward to hearing his story and letting him share it with you guys. It's inspirational to just talk with people who are just like us, who just started this, pushed hard, and we're able to grow a company and make something happen. So look forward to it. Trying to think if there's anything here. I think we got a few more minutes. He said he's going to jump on around 6:45, so I expect him to pop in here any minute. But has anybody actually ever listened to, I'm sure he'll tell you this, but anybody ever listened to his podcast? He does have a podcast as well. I actually have. I skimmed through. And one of the things I like about his podcast is that he's got like quick 5-minute, intros and quick 5-minute audio clips, which are great because there's so many podcasts now. Some are way too long. You just can't. You don't have enough time in the day to listen to them all. So I definitely recommend that. I'll throw his URL in here for you guys. But we've actually seen John and hung out with him when we were able to do events. We actually caught up with him down south. I can't remember where was the last time we saw him, John. Was it Dealmaker Live, maybe?
It was Dealmaker Live, yeah, in Dallas.
Yeah. Dallas. Yep. Okay.
Yep.
Yeah. So, it was good talking with him. I know you guys hung out with him. I was busy networking and stuff, so I didn't really have an opportunity to chat with him. But yeah, so he's definitely been able to grow. I'll do a little introduction when he hops on, but essentially he's got 590 units right now. I think he's either helped raise around 70 million with his investors. So it's pretty impressive. It's pretty cool to be able to see. So I look forward to hearing from him and just kind of what his advice is. He's a family man, so I know a lot of us are trying to navigate the W-2 life, the family, and trying to do real estate all in one. So it can be kind of challenging to achieve all those goals. But anybody have any questions? From our perspective, our 24 unit, we've been very lucky and fortunate. We haven't really had any issues with COVID. In fact, I'll be there tomorrow to just bring some supplies to our contractors. But we've been pretty fortunate. We haven't had any issues with any kind of evictions or just dealing with any kind of delinquency. So we've just been fortunate, crossing fingers. Hopefully it stays that way. But overall, it's been pretty good. All right, looks like he's jumping in. Sweet.
Perfect timing.
Nice. John, I think I see you
Got it.
jumping in, bud. I think you're on mute, boss.
Just trying to make it look good, like he's logging in and doing
he's
something.
got the suspense. Oh, that's great.
Going on? How you guys doing?
Hey, man, how you
John,
doing?
how's it going?
Living a dream. How's everybody today? Happy New Year.
Yeah, for sure. Happy New Year. Thanks. I'm
Happy
really
New Year.
good. Thank you.
Awesome.
Yeah.
Give me 1 second. I'm just gonna put my phone on mute.
Oh, sure. That's a good tip, actually. And mine will vibrate
And
for
I
me.
am good.
All right.
Um,
Hey, thanks for jumping on. I really appreciate it. Like myself, family man, I know it's tough trying to step away from the family at night. So thank you for jumping on and talking with us and just sharing your story.
nah, no worries, no worries. I'll be here right after this. I got to jump on another call for my 62 unit. So we have a meeting once a month, but this is an early one because sometimes the 10th falls on different days, but they just want to have an early one this month.
Yeah, it definitely seems like in this business, you do a lot of night calls.
Oh, well, what's funny about it is because if you really think about it, the way you get started is it's almost like a night job because you're underwriting deals at night and then you're sending emails out almost at night to be responded to in the morning so that when you're at your day job, you're only dealing with email communication and you don't have to go ahead and look at your underwriting or any other things that you need to do. I mean, Gary and John, they can tell you that when they were underwriting deals, it's a lot of weekends and nights visiting properties. And man, I mean, we talk about it. We talk about what we go through.
Yeah. Yeah, it definitely is a hustle and a push to achieve those goals. But it's great to talk to other people who.
But when you got to travel to other states, though, that's when it gets pretty interesting.
Yeah.
Well, let me do a quick introduction for you, and then I'll let you tell your story and then share whatever it is in your wisdom. I really appreciate that. So, currently John has 590 units of commercial real estate. I believe it's worth, is it 70 plus million? I think you said that's over now. That's amazing. That he asset manages for his investors. John, along with his wife, Jen, and their two beautiful children, boy and a girl, a boxer and two cats reside in South Boston, in the South Shore of Massachusetts. Haven't been there. Sounds pretty nice. Might have to go hit you up one time. John Fortes is also known as a passive investor consultant. Founded the Fortes Company, which partners with working professionals seeking to invest in diversified commercial multifamily funds because they just don't have the desire or the time to manage their own assets. So we all know what that's like. I got to throw this out. There's a little fun fact about you that I did not know, that you are looking to become, or you are an NCAA men's basketball official right now. And I think I've heard something about you want to do it in the NBA as well.
Half right? So I am an NCAA basketball official at the Division III level. My goal is to get to the Division II and Division I level. I don't have aspirations for the NBA, but if they came calling, their training is phenomenal. That
really,
I would have to entertain it.
Wow, that's amazing. I got to ask, what is it? Are you actually doing any officiating now, or is it too challenging with COVID?
Right now, the Division III has not even started. And the funny thing, I don't know, the world and the universe, you asked that. I just got the email for the meeting to see if we're going to have something in January and February for Division III. And that's all I know right now. I don't know where they're going with it. I don't know if they're having a season, but what it will be is a lot of teams did opt out. So that's how it looks right now. But the D1 is happening at the D1 level. Just to give you an idea, they're testing almost like every day. And then they're being monitored as they walk into the building. I also do high school locally here, but I opted out of that.
Okay. Well, I find it inspirational that on top of the family, on top of running this business, you still want to and are able to do stuff like that. So it's just phenomenal. It just tips a lot to your work ethic for sure. Yeah. So tell us a little bit more about your story and fill us in.
Awesome. Thank you for having me, guys. Jamie, John, Gary, hello. I know we have multiple conversations. Gary and John, we're on a group text chain practically. So I'm always asking you guys about your project. And if I could be a resource, just ask, right? So the thing is in this business is you got to ask a lot of questions to get to where you want to go. And that's kind of how I came in, because as a basketball official, I needed to free up time. Started reading books and trying to explore the stock market, but I realized I needed more passive income. Real estate gave me passive income. At that time, I wasn't investing in anything other than my 401k. So I took what I knew about my own personal home, the value. We bought a foreclosed home, basically fit to model us, renovated and repaired a bunch of little things, little projects. You know, it's an ongoing thing with the home, and saw the value grow, the equity just shoot up. It's just kind of. Oh, I'm sorry. I didn't even press anything. Sorry.
They hear everything.
I know. So what happened was I saw the value and I said, all right, I'm listening to all these podcasts about real estate, reading books about real estate, and also reading books about the stock market. What I really do understand is real estate. I understand forced appreciation. I understand appreciation. I understand equity. I understand real estate in general. So that's kind of how I got into it. I started exploring bigger pockets, started asking questions there. What I did do was I wanted to borrow my first investment property. Realized I am a safe investor. I like, cash flow. So I bought a turnkey. If anybody doesn't know what a BRRRR is, buy, rehab, rent, refinance, and repeat. You just keep doing the cycle. And I realized I'm just kind of like, do I want to do all that work? I didn't have the time for it. I'm working a, IT job, refereeing, and I noticed that my aspirations is starting to be where I want to go with the D1. So at the time, I'm not working college. I'm doing just high school. And I know that I got to go to all these tryouts and stuff. So real estate investing is kind of what made sense for me to free up my time to go ahead and pursue that. I have a supportive family that allows that. My wife, we talk about everything. We talk and pray about everything when we're starting to do investing. So the minute we had under contract, the minute we were about to go close our single family home, and I'm in Massachusetts. My single family home that I purchased, investment home, is in Florida. I'm cool with that. I have a local family in the area. They know the area. It's good. Tenants are good. It's just, it's doing exactly what we underwrote it to do. To this day right now, we are actually refinancing that because the rates are so insane. So if you have investment property, explore that option. So from there, I told my wife that's the last one we're going to do. We're going to just go ahead and start looking at multifamilies. And I didn't realize I was going to go into big apartments. And I just kind of was naive and just asked a lot of questions. I joined a lot of private Facebook groups. And my goal was, if Jamie asked a question in the group, my goal was to be the first one to answer and say, this is what I heard on a podcast. This is what I read in a book. This is what I read on a blog. And I would share the link of the blog or whatever. And then if I was absolutely wrong, Gary would come in behind me and like, no, that's not how you do it, but this. So I wasn't scared to put myself out there to get the information I needed, because back then all my alerts were on. Right now I have no alerts on. If you tag me in anything, I don't see it until I go on, because I've built up such a, I get tagged in things that I just can't afford to take away my time from to go ahead and focus on other things right now. So social media to me is kind of like on the back end. Back in the day, it was more on the front end where I used it as my resource to go ahead and ask questions, because people, when they answer questions in those groups, you get almost instant responses depending on the size of the group or community. So from there, I purchased some education, some multifamily education. I've never gotten a mentor, but I asked a lot of questions. So I feel like that's kind of my mentors when I'm whoever's answering the question. To now, I do have a mentor with funds. It kind of naturally came. It's funny how that happens when you're asking a lot of questions. But yeah, so I partnered on 62 units because I was a part of a community when I purchased some multifamily courses, online courses. I champion them. If you can find a course to teach you anything from cooking to whatever you want to learn, I encourage it, because it's only a couple $100 when, you know, colleges are charging thousands.
Yeah,
You can learn
exactly.
anything, right? So here we go. So shortly after that, I syndicated my first 41 unit. Oh, I'm sorry. We partnered up with a bunch of people on a 62 unit. That's the one that I have a call on after this.
Hmm.
And then that was a type of project that I would never put investors in. And even though I'm a little safe, I understand that I had a bunch of partners that I went into this where we were supportive of the type of potential. So it was a 62 in Johnson City, Tennessee for 1.2 million. Excuse me. And we putting in about $1 million of work into it. But that was through bridge loans where they're helping with the rehab process. Excuse me. But the value of that project is going to be a $3.4 million project.
Wow.
So, excuse me, sorry.
There you good. Yeah, that's awesome. I mean, you don't see the price point, 62 million, 62 doors at 1.2 million. That's tough. That's tough to find now for that price.
But it's extensive rehab.
Yeah.
We still haven't gotten any cash flow from it. That's why I would never put investors in it.
Got it. Yeah.
So with that said, the returns are going to be explosive when they finally get there, but we haven't gotten there yet.
Sure.
Fast forward 5 months later, 6 months later, we are literally syndicating our first 41 unit, Chattanooga. And then I would say almost like a year after that, we offered another 528 units in Irving, Texas.
Wow. It's a big one.
So in the middle of COVID, before we even held the property, the 41 unit, for about a year, someone else came to us and said, hey, we want to buy it for you. We said, we can't sell it to you until February. So if you want to meet us at this price and wait till February, and if you're probably syndicating, you're probably going to say, give me the longest, more time. Yeah, absolutely. Instead of 60 days.
Right.
Yeah, I'll wait. Right. So they came to us in October. We told them to wait until they came to us in November. We told them if they could wait till, no, it was October. I'm right. And if they could wait till February, we'd be happy to sell at that price. So we came on the contract. We put that in, and then February, March, April, May, we finally exited from that at a 1.5 multiplier. And when you have an asset that's kicking off like 9% cash on cash return, if you know you're going to exit in 5 years, and that's the goal of what you told your investors, it's not like we told them we're going to buy and hold forever.
Mm-hmm.
So if we're kicking it, if we're keeping it for 5 years, the value is, if we're getting half of our returns in 15 months of holding, it doesn't make sense. And this is when you're talking to other investors. It doesn't make sense to hold it for another 4 years.
4 years, just for that half.
Just for that half, right?
Yeah.
So if that's what you promised your investors, you got to make the right decision for your investors. And that was the right decision for our investors. And the reason why people always ask, why wait until a year? If you don't, you get with short-term capital gains. And now when I'm giving Jamie his money back, Jamie will never invest with me again because, hey, you're going to sell in less than a year and I'm going to get taxed the hell out of it. So that's kind of one of those things where you want to know why you're doing things and why a year or when to sell. So if that's your exit strategy, you got to know when to sell and if it makes sense for your investors. So
wow, it's great. That's amazing that you went from the size and then jumped into that 500. That's a pretty, you can tell us a little bit about how that all fell together.
Yeah. So like conferences, going to networking events and constantly having conversations. So things like this never stop happening for me. I'm always trying to be around a lot of people. I'm always trying to share experiences. I'm always trying to talk multifamily. And John will tell you straight on that conference, we came back from dinner one night and it was probably like 10 o'clock when we got back from dinner, right after the conference. And we stayed in the lobby talking just pure multifamily till 12:30 at night. It was to the point where I knew I was my feet were hurting. It was the only reason why I was like, John, I gotta go get out of these shoes. I probably would have went and changed out of those shoes if my room wasn't so far and came right back. But yeah, it was one of those situations.
Yep. Yeah, those events are great, but you're absolutely right. They usually are going to have long days. You're going to pretty much be up really early, and then you're going to
If you
socialize.
like being around people and you like talking about money and real estate and
Life, everything,
potential
yeah.
returns and opportunities, I mean, it fits, right? It's a little bit uncomfortable at the beginning talking about, hey, you got 100,000, you might want to explore the opportunity of this investment, but it never comes off like that in the beginning. Oh, you got 100,000. Hey, I got something for you.
Right.
It sounds like that in the beginning. So you got to have those conversations to know how to have those conversations later. But I do have a presentation. If
Sure.
you want me to go ahead and
Go for it.
share
Yeah,
the
you
screen.
should be able to share your screen.
Awesome. So right now what I'm focused on is funds. And I think it's a cleaner process. So I'll use Gary and John as an example because this is such an awesome meetup. And I want to actually, tell you guys, I'm grateful that you guys are actually here because learning something about how you can actually change the trajectory of your family's just legacy starts with meetings like this. I don't know why this keeps going off. But yeah, so this is my company. It's my marketing arm from this. So this is what I use to run my podcast and webinars and anything I need to put out there for exposure. I throw it through the Fortes company. Now, this is basically what we'll be talking about. We'll be talking about the team, type of projects we do, our services, and not that I'm trying to sell you guys something. It's just, this is what we do on this end. And then the real estate fund, I'm going to educate you guys on syndications and real estate funds. They're essentially the same, but there's a little bit of difference. A syndication, you're going to be able to go ahead and do one deal at a time. We're going to syndicate this 38 unit and that's it. On a fund, we're going to raise 3 million and go buy 438 units, if that makes sense.
Yeah, totally.
So obviously you guys, I don't need to put that up, but this is just basically a slide just to let you guys know the disclaimers of I'm not trying to sell you guys anything. This is not a securities sales pitch or a syndication, but you'll notice a lot of these even on prospectus, you'll see this type of a disclaimer on any offering you might see going into a deal. It's just little things that keep you going. So Warren Buffett's famous quote, if you don't make money in your sleep, you'll keep working until you die. But I'm sure we've seen this all over Instagram, social media, Facebook, whatever you guys use, whatever platform you use, you've seen this thousands and thousands of times, but it's so true. So this is my company timeline. So in 2008, that's when I basically started and launched. That's when I bought my first, what's it called? Single family home in February. And then the Buffalo Ridge came in September. And then the following year came the Chattanooga. I got to fix that. And then, yeah, that same year in 2019, Chattanooga and Vista Ridge happened. So I got to fix that. I didn't catch that earlier, but yeah, now that I'm talking through it, I'm glad I had this.
Perfect. Glad to help.
And now that's what I'll be working on going forward is the fund. So the goal is to basically source the capital and be able to go ahead and diversify each investor's capital by making multiple purchases under one fund. And a lot of companies are rolling that out and starting to do that with, I just had a call with one of my good friends, Dylan. He just rolled out a fund for mobile home parks. You'll see this happens is so common in the hedge fund game that, they start funds and then they go ahead and pitch institutional investors who basically they start like these $500 million funds and they'll go and get 100 million or 50 million from let's say a pension fund that's looking to diversify. So they'll just throw capital at their funds and hoping that they go make a profit for them. So it's a very common investment style. It's now starting to become more explosive in the real estate world. Even big companies that I know that just made an announcement, I got an email recently that they're starting to roll out a fund because they're coming across, when you're coming across a lot of opportunities, and especially during a time like right now where you think that there's going to be a lot of, let's say, good opportunities that you can take advantage of. If you have the capital, you can go ahead and jump on those opportunities.
Yeah.
If you know what you're doing almost immediately because you have the fund already, as opposed to syndicating where you got to go ahead and, you know, raise the capital while you have it in contract. It's good if you know a lot of people that, like, if you have a good network, you could go ahead and start raising for a fund, because if that's who you're intended, I wouldn't say you start immediately, but you know what I mean. You start a fund,
Right.
raise the money once, and then go and do what you do. So I think it's a no-brainer, and I thought this should have been happening years ago. So this is just another Robert Kiyosaki. I think we're all familiar with him, but I don't want to focus on that. But here's how you get started. So you want to reach your goals. This is why everybody starts. My reason was I needed time. I needed to be, as a basketball official, what happens is if I don't have availability, when they assign me a game, they take away the game and it goes to another person.
Mhm.
As an official, I am an independent contractor. The NBA is the only referees that have a union, and they get hired and they're on the staff. So whatever if you get 2 games that year, you get 2 games that year. That's it. But you're hired at a salary. So as far as high school and college, you're an independent contractor and you're working game by game. So having time to be available was my why. So there's a bunch of different whys. If you're looking to replace your income, just preserve your wealth and grow your savings, or just reach some financial goals. We each have a why. So this is basically who I at my company. This is what I use. My tax guy, my accountant guy. My wife went to school with him. He's very knowledgeable. I was actually on the phone with him earlier today about LLCs and different things, and fund conversations about the fund too. So he is basically my go-to when I need to ask any tax things. I don't try to read books about taxes and then go ahead and study the tax. I already done it. I pay him to do it. I pay him to do my taxes. I trust him, and that's basically, everybody should have that team member. As far as cost segregation, we got companies that you use for them, and then also attorneys that draw up contracts. There's several that I've already networked with. The fact that I have a podcast, I get to go ahead and interview people and then just build relationships and see if I want to participate in working with them in future things. As far as, for instance, a syndication attorney, when whoever's drawing up contracts, legal documents for those type of stuff. I like to ask a lot of questions. So podcast was just natural for me to kind of have to go ahead and ask a bunch of questions. Now, this is the benefits of it. My motto is it's beating inflation 1% at a time. And that's basically all I'm trying to do. I'm just trying to create cash flow, but not lose the value of my savings. So whatever you have in your 401k, if you're going to use a self-directed IRA to invest with, if you're going to use a pile of savings and inheritance, however, home equity, I don't know how you invest, but there's a bunch of reasons. And one of the this is just for the reasons how real estate basically pays you through appreciation, cash flow, tax benefits, loan pay down, which is not listed here, and the hedge against inflation, which is the wealth preservation. Sorry, the slide is not. I'll fix that. But basically, that's 5 ways real estate pays you, and that's why I like real estate. When you understand that philosophy, where appreciation is usually historically 6% a year, not every year, an average. Inflation eats at your capital at about 2% a year. I I don't buy straight on appreciation either, though. I'm buying mainly on cash flow. And that's kind of where I need to supplement my capital so I can go and free my time to go and do what I'm basically pursuing.
Right.
And then the tax benefits is the mortgage interest deductions and depreciation. So for instance, I'm in Massachusetts. I don't have bonus depreciation, and some investors might have the luxury of having bonus depreciation. Outside of that, wealth preservation. If you're just trying to sustain what you have, it's not good to just hold on to it. So if it's your last 50K, don't invest it. I always tell my investors, don't invest your last 50K. If that's your savings, I'm not taking it. The reason why is I don't need you coming to me asking me for it because that was your savings account.
Right.
Outside of that, if you do have 100 grand and you got a good savings, I don't like sitting on my capital. In fact, if I have a lot of capital in the bank, I'm looking for a new investment to put it in. The reason why is I know the bank is eating my capital. Every day the dollar's getting lower in value. So that's just kind of my thought process. So I kind of keep it moving. If I can keep it moving, I can keep it coming. So that's kind of how I think of it. It's a revolving door for me.
Sure.
And then the advantages of a real estate fund is it's basically the diversification is what investors really like about it, because in a syndication, it's transactional deal by deal where you can go ahead and it's good. I think syndications, however you're investing in real estate, whether it's real estate, residential, commercial syndications or a fund, I think you're already doing the right thing. I like the fact that as you start to evolve and you start to progress through there's different levels to this thing, right? So you probably heard that saying before. So the fund is like, all right, I already know what I'm doing. If I had this chunk of capital, I could take down that. I could take down a whole block if I wanted to, or I can take down the 3 biggest assets or the 3 best assets that come across in different states that you already invest in. So basically the diversification factor. If I am an investor that's investing solely in syndications, here's the process. I have to, I have to connect with the sponsors. I have to trust them. 2, I have to review their offerings. 3, I might have to sit in their webinars. 4, I might want to underwrite the deal. 5, I just got to make the decision then, right? So that's basically the 5-step process of investing in a syndication. How about we do that once and go ahead and invest in a fund? And when you're investing in a fund, what you want to do is you want to make sure you know what the fund is going to be invested in. That's basically where the investor needs to know what kind of opportunities we're going to invest. Are we going to invest in mobile home parks, self-storage, multifamily? My funds, I only stick to my bread and butter. That's multifamily, commercial multifamily. I'm not looking at residential. I'm not looking to go do a bunch of fix and flips. I'm just doing straight commercial multifamily. I'm pretty specific, and that's it. The preferred returns, similar to a syndication. Professional management, similar to a syndication. Tax benefits, similar to a syndication. And qualifications, if you're accredited or non-credited. If it's a 506B, 506C. Jamie, are we familiar with those terms, the whole group?
Yeah, obviously, that was one of the questions I was going to ask you. If based on when you register and file with the SEC, is this still like a Reg D regulation, or is it 506C8? What exactly do you have to file with them for to actually do a fund versus a syndication?
Great question. Whatever way you want to go ahead and tackle it. So a lot of people think that if I could advertise this, I'd be able to raise all the capital. Not so much the truth. You got to have a track record. You got to have some, some kind of like cachet behind you,
right,
to be able to do that. Now the marketing's all great. If you're a great marketer, you might be able to do it, but if you have a bunch of friends and family, 506B, the relationships you already have, work on those and go from there. So your attorney will literally drill you for these, whoever you're using to drop these documents. excuse me, saying, where's your strong suit?
Mhm.
Where do you think you can, find more? They'll talk you through it to find out where your focus is or where you have the best potential of succeeding at that. If you find the right attorney, that is. So 506B, you can use your own network. 506C, everybody has to be accredited and you have to validate their accreditation. You either use a third party. You can use verifyinvestor.com, which they go ahead and pay $59 and then they go and get self-verified and then they bring you back the documents. Or you can have your attorney draw up a document where they hand to their CPA and their CPA basically determines their accreditation status instead of them. So it's always kind of like not the person, it's someone else accrediting the
validating
their accreditation.
I gotcha.
Instead of them doing it. Yeah, I mean, yeah. But if it's a 506B, only 35 non-accredited can be part of that. And then it is that word of mouth where John might be like, yes, I am an accredited investor. And you just take their word for it. You don't have to validate anything.
Gotcha. Okay.
You can always be like, well, he told me, so.
Right. Sure. So if I actually wanted to do a fund versus just a property though, I can still use a 506B. I don't have to have anything different. I didn't know that. Okay, cool.
Yeah, absolutely. Yeah. So if you want to raise a fund and say you guys pull together like 2 million out of this group and you're like, we're going to buy 4 assets in the New York area and we're just going to go ahead and, we're going to do, that's the plan, right? 4 multi-family units. We don't know what the sizes are going to be, but it's going to meet the range of 500,000 a piece.
Okay.
Right? What you'll do is you'll set up the documentation just like you would a syndication. That's it.
Huh.
That's it. And there'll be a manager. There'll be a, just like the syndication, a GP and an LP side. And then that's it.
So you establish those documents beforehand, and then let's say you find the property, 3 months later, do you have to go back and revisit some of that documentation to update anything or?
No, once you have all your commits and everybody probably, there's a couple ways you can draw down the capital. You can draw down the capital day one. You can draw down the capital per each investment. There's no wrong way to do it. It's just have your documentation set up so that it gives you some runway to find the assets. So if you take down all the capital day one, you have 3 months, 4 months to invest that without having to start paying the pref on it.
Got it. Very cool. Okay. That's awesome.
So yeah, it's just more information about that. I think so the fund can typically be 10 years, right? So that's basically because the hedge fund game, that's what they do with their funds. But if you're looking to take down a bunch of different properties, you're not going to do a fund with less than, you're not going to do a 5-year syndication paperwork for the fund, right?
Right.
So you'll probably do like a 7-year, even though your goal is to probably get out in 6 or 5 or whatever. You might even want to do 8. Your attorney will probably tell you do 7 with a 1-year extension, because you never know if one of your assets you bought in year 4 and you're approaching year 7 and that's only 3 years of holding on that. You might want to hold it an extra year.
Gotcha.
So you have those options and the flexibility of a fund. But excuse me, one thing is there's no reinvesting of capital. So what I mean by that is if we exited in 3 years or 4 years on the first investment, we're not putting that capital back into the fund. Any exit is going back to the investors. The reason why is you probably already started fund 2. That's why. So you don't want to keep an ongoing fund 1. You want that to come to an end eventually, and then you're focusing on fund 2. So just to give you an idea, you guys raised $2 million fund 1. 4 years from now, you decide to raise another fund. I think we could do 4 million now. And then 3 years from there, I think we could do 8 million now. And as those are dissolving, you're starting to create funds, but you're taking down all this assets. And guess what? You're probably buying the whole state at that point.
Yeah, no, I see the scalability of it. That's pretty cool.
Yeah, so we just talked about it. Basically the structure, basically the investments on the bottom layer. The real estate fund is right there. Then the investors get paid first, and then the management company goes ahead. So all the assets are reporting to the real estate fund. So I know John and Gary probably underwrite for a 70-30 split, right? Here's the thing: if you're taking down assets, go ahead.
Sorry, someone's. I'm just putting them on mute.
Oh, no worries. So if you're taking down assets, already underwriting for a 70-30 split, in my opinion, I personally think you could underwrite it since the fund is already at a 70-30 split. You can underwrite the investments at 100% because you're not splitting that investment. Everything's reported to the fund and then the split happens.
Oh,
So traditionally in a syndication, deal by deal, you're underwriting for a 70-30. But as you're underwriting these type of opportunities for a fund, you need them to basically achieve 100% because you're not splitting them at that investment level.
gotcha.
So if that makes sense to anybody outside of John, Jamie, and Gary, feel free to ask questions on that. I don't mind. But this is basically the call down process that I explained earlier. You can identify assets and then call them down to investors that's already committed. So I'll use an example. Jamie's committed 100,000, signed all the paperwork, and I told him upon the PPM signature, just wire 25%. I'm sorry. So he wires me 25,000. And that's with everybody. So I'm using Jamie as the example of the one lone investor here. So now I take the 25,000, I go and I buy a property. And now I identify another property. Jamie, I identify another property. Gonna need 50% now. This for 75%. And then so on and so on. But now let's say in the investment period, I identify another property. We're in this fund, 2 properties. He's at 75%, 75,000. At the end of an investment sourcing term, I can say, hey, we released those no longer committed at 100. You are in at 75 because we did not identify. We're not trying to find deals just to find deals for the sake of the fund. We're trying to find deals that make sense for the fund. That's the way you kind of go ahead and organize and structure and plan that type of process. So what's the investment process is? Obviously we're sourcing leads, we're underwriting the deal, we're trying to gain exclusivity because of the due diligence, trying to look at the asset once it's under contract, and then maybe even renegotiate. But obviously we'll probably, that should probably be in the ahead of the gain exclusivity and the due diligence. But the due diligence actually is probably part of right where it is, and then right after the negotiation process, because I would say you need to do some sort of due diligence before you want to go ahead and put in an LOI.
Sure.
Right?
Sure.
So I would say the due diligence is definitely before and after the negotiating purchase price. Now, the capital raise of the fund is, if you already have the fund, you can go ahead and close whenever you want after inspections and all of that. You can, maybe bump up the dates, hopefully with the seller. Or if you're syndicating, difference is you're raising the money during, let's say you're raising this money as you have the deal under contract. So you see where that position is right there, right? So you see how sometimes there's that 6-day window where you're trying to raise capital and float it all at the same time.
Yeah, so it's a lot of work at the same time.
That takes that away.
Right, yeah. Exactly.
So the investment life cycle is this. I think we talked about it, is the formation of the fund structure, and then we'll raise capital, and then we can go ahead and start making acquisitions. And then once we purchase everything, or we purchase something, you hear the common, John and Gary can attest to this, now the real work begins whenever someone closes, right? So you hear that all the time, right? But the real work is from day one to day day 100 when it's over. And then you got the reposition. That's part of the operations, right? So those go hand in hand. You're making sure you got the operations. You're making sure you got the right team in there. Are you keeping the current property management team? Are you self-managing? Are you actually gonna replace the property management team? So you got to make those decisions too. And then reposition. You got to trust the property management team to go ahead and do what you need to be done, because you know what the business plan is, right? And construction costs go up, so you got to pencil in for that. I mean, when do prices really go down, right?
Right. I wish.
And then you start looking for your exit, you refinance or you sell. So the way I underwrite deals, and I think John and Gary and Jamie understand this, is we never underwrite with a refinance in the deal, because we want the deal to look strong without the refinance. Because if an investor comes back and says, John, you told me we were gonna refinance in year 3, what happened? Now they're gonna hold me to that, right?
Mm-hmm.
So things can change, and you can't refinance, like COVID, right?
Exactly. Great example. Yeah.
Mhm.
Right. So now these investors are like, you told me a refinance, I was going to get a return of a portion of my capital. What's going on? So that's basically the life cycle of the deal. And then here's the timeline. So basically, when you start those documents and now you're fundraising, it's a lot of calls. I like to tell people, when I'm sourcing deals, investors are on my time, because I'm trying to find a deal. But when I am, and I don't mean that in disrespect, I'm just saying I have a window of time that I allocate to people, to, investors.
Right.
But if I'm raising capital, I'm on their time. So if they're in California and they want to talk to me at California, 9:00 California time, I'm on the East Coast, I got to be on that call. That's what it takes to raise capital. You have to be on the time of the investor at that point, because it's their decision now. You can bring the opportunity all you want, but they got the final say.
Sure.
Then the sourcing and closing opportunities. You see that 4-year window. It could be 3-year, it could be 2-year, however long you want to do it. On a 10-year fund, we'll make it 4 years. And now you see why the fund is 10 years, right?
Yeah.
And then you're managing and improving. Say you took something down day 1. Yeah, that's fine. And then the exits can typically happen anywhere from, like, I like to say 3 to 10, because you never know. But at the end of the day,
Right.
5 to 10 seems pretty reasonable. You're trying to hold it for 5, right?
Sure.
That's the goal. You're not trying, but the plan is to hold for 5. And then if someone comes away and blows you away at year 3, like I said, you gotta do what's right for your investors.
Right.
Never depend on a single income. I mean, obviously passive streams of income is what we strive for. We're always trying to, create that second, third, fourth, fifth, sixth. So keep doing it. And then the sources of fund. For instance, people in this group, if you invested in a John or Jamie or Gary type of deal, private and individual, you're a private investor, right? But also there's other ways that they can raise capital through pension funds. There's a software out there called Preqin. If you're on Preqin, you can start networking with a bunch of fund managers. And what I mean by fund managers, they're usually pension fund, endowments, foundations, institutional investors, insurance companies, and universities, all looking to deploy. Maybe they have a $1 billion fund, and they allocate 25% to real estate. They're looking for real estate people on there. Family offices, excuse me. I just interviewed Richard Wilson, who runs familyoffice.com. Family offices work differently. They're looking mainly not to invest as an LP in deal. They're looking to JV in deal. So if you come to them with an opportunity, one, they're looking at the fees, but they're looking at it in a manner of, we want you to basically, they're not removing your fees to remove your fees and be greedy about things. They're making you they give you incentive. They want you to work. So just to explain, that is 2% asset management fee. And let's say there's a disposition fee and it's a 70-30 split. Fair to single investors, I think that's pretty fair. But a family office is going to say, take away the disposition, take away the asset management fee. Also, we'll give you back, they might say, we'll give you back all your earnest. We'll fund the deal. But now it's 60-40 and you guys operate it. I'll take it.
Sure.
I mean, so it's not about the acquisition fee at the end of the day. A lot of people get hung up on, and I have an investor that will not invest in a deal that has an acquisition fee. And it's just a old school way of them coming through of lifestyles and unlimited.
Right.
It's a group out of Texas. They started, I might even, I can't remember exactly where they started, but they grew and they basically, they have these principles that they share with their investors. And one of them is not investing in a deal with the acquisition fee. And I explained to him, I said, look, acquisition fee for me is not me eating for my family. Acquisition for me is basically getting the capital and going to buy a bigger deal afterwards. Because if I'm putting my earnest funds in a deal and then I'm gaining an acquisition fee, my goal with that acquisition fee is to basically make it bigger so I can go and take down a bigger asset.
Right.
For investors. Obviously bigger is a better scale. So that's what I want to do with my investors. And I shared that with him. And I told him that's not how I go ahead and operate. I look to go ahead and scale with the acquisition fee to bring you a bigger deal at the end of the day. So, but there's a lot of people that just are raising or being part of deals just to get a piece of acquisition fee. And you know, whatever their reason is. I mean, you know, everybody's situation is different. I'm not here to talk about that, but I'm just talking about how the acquisition fee helps you scale to bigger things, because you're already there to scale anyways. You're already invested in the syndication to scale anyways. So these are the different type of companies that are sourced for capital. And then the 5 important elements is obviously the term. Like I said, it could be 7 to 10 years. It all depends on the fund. And then the management, you know, vet the sponsors. You guys know that. Trust the sponsors. If you trust someone, you're most likely to invest with them. Yeah. So basically the market, you got to know the market, understand the market. If you understand the market, you know, they say invest where you want to retire, you know, that's what, or invest in your own backyard. That's the biggest things that they say. So no one's invested in an area where they don't want to travel to, right? So the preferred return in the split, usually there's a waterfall that's called a waterfall. So the first hurdle is usually the preferred return. Everybody you think is familiar with the preferred return. If there's a 8 pref, you're going to get 8% of the cash flow before the managers get paid. That's basically a lot of managers pay themselves first, the asset management fee before the pref. And then there's a lot of managers where they'll pay the investors first and then the asset management fee to them afterwards through the cash flow, and then distribute the rest 70-30. That's basically the structure of the waterfall. And then there's usually a split of exit on a 50-50 split on an exit, but usually that's on the back end. So if the sponsor does what he said he was going to do, I think he should be compensated that way. And for instance, if it's a 70-30 split and we said we're going to double your money and in 5 years or whatever, and we reach those goals, I think it's only fair to go jump that to a 50-50 split.
Sure.
And usually you might see that with experienced syndicators and sponsors. But also if you don't see that, it's because usually sometimes it's a new sponsor where they want to, you know, you treat your investors good on the first couple, right? So
Right.
you give them almost everything and then later on they invest everything with you. So that's the thought process. You become financially free when your passive income exceeds your expenses. I think that's what everybody's trying to do: chase and pursue their goals, and you know, do what they love for the rest of their life.
Right.
These are the primary markets we focus in, but you know, the Southeast, the rustic beltline, and basically Colorado, Texas, Tennessee, in Georgia, Florida, and Kentucky. My markets where I invest in. And like I said, I'm out of Boston, and these are just areas where I like to find value deals. Mom and pops, best type of people to buy from. People that are inherited the property that don't know how to manage it. That's basically how we bought the 62 unit. And then there's sadly deaths that happen, that the partner might have died and they need to dissolve the interest of of their investment and stuff like that. So, or divorces. So that's basically the biggest reasons why how we're sourcing deals. Excuse me. We're trying to identify those type of opportunities and then go ahead and taking them over. And then basically the acquisition process is the high quality. Yeah, these are the type of opportunities we're looking for. The high quality assets, 1999, minor rehab, 500 to 5K worth of rehab per unit. And then there's the value add. That's the one that's thrown out there the most, where you hear everybody, yeah, it's a value add. Value add, those are the under market rents. It's going to take some time to get the cash flow higher, but it's worth it. You know, it's definitely worth it. That it's already cash flowing, but it's under market. The financially distressed, that means they are running out of capital. They need to do something, divorce, or, you know, just name it. They're currently going through it and they need an exit. Physically distressed, you can just look at it and you know it needs work. And then the owner management distressed means it's bad, poor management in there. It's kind of with another type of value add component in there, but it's just a different way of identifying assets. Hey, is that manager really good? And as you start becoming aware of your locations, you know which property management teams are better than others. Right. And I think John and Gary can attest to that. So our last projects, the 528, the Buffalo Ridge is the one that we did. We put up that new sign there. And then the Vista Ridge is the one we actually exited on. And then we just we were part of another deal, 167 units in Augusta. So who doesn't want to go to Augusta, right? So give me a reason to go to these places. That's where we're going to invest in. Sure. You know, just another headline here. And then basically what else I offer at the Fortes Company is I help consult, where I have a few meetings coming up about funds, right? People are connecting me with people because I've been on their podcast talking about funds, and I just got a few emails and LinkedIn notifications about connecting people that are interested in learning about funds. So I went off and created my own calculator because there wasn't one that I could find out there. I created one that here's a way that you can help. If you have a network, right? And you come across a bunch of deals because you've already started networking with a bunch of sponsors, and you know which sponsors you would invest in that you've built relationships with, raise a $1 million fund and go and deploy $250 in those sponsors' deals at a pop. Diversify that way. And I designed a calculator that shows the returns on those on something that maybe your fund is because they're going through you and you're playing the middleman, you're investing in those syndications as an LP, but it is a different structure process. You got to fill out a form with the attorney, an exempt RIA form, because you're not consulting advice. You're not giving consulting advice. You're just building a fund that is going to go and invest it as an LP in other deals. So you're the GP of the fund, and you're going to invest it in all these great deals that you have already sourced and been a part of. Because as a firm, I'm reviewing hundreds of deals a quarter, let alone the individual investor that is reviewing probably, let's say, 5 deals, maybe a quarter, because they know maybe 2 sponsors. I like my odds of finding a deal and reading out the good and the bad because of my experience of being able to underwrite and being able to basically know what's going on in the industry because I'm already plugged in. giving your investors a 6% and going and investing in 7, 8 pref type deals, everybody wins. And you can still double their capital in those type. And a lot of people, if you go ahead on bigger pockets, you'll find a few people pushing back on those types, saying, hey, how go get feed twice? Well, you're not feed twice, really, because on a prospectus, here's what happens. Here's what your projected returns look like. This is what we're forecasting. Those are already built in with the fees. You already know what you're gonna, what you're likely to get. So if you trust the sponsor and you've already invested with them before, you know that your fees on top of that is not really double feed. You already see what the returns are on the fees, so they're only paying your fees. If that makes sense, that's how it makes sense for me, and that's how I figured it out from there and built the calculator. And then obviously Eric Thomas, he's one of the best motivational speakers, and at some point you got to unleash the potential. So it starts by doing. So like I started with a single family, and then I started networking like John and Gary and Jamie are doing. Just found that opportunity out there and partnered up, and then all of a sudden raised the capital, and they did it. These are your guys, man. These are your guys. They're doing it. And then that's where you can find me. And if anybody has any questions, I'll be happy to take them.
Oh, that's great. It's actually, it's interesting. You shed some light on the whole concept of a fund. I just didn't view it that way. But I also didn't realize that it could be set up very similar to what we're already doing. And then basically it's the same process we're already doing. And it's just, instead of trying to do it for every single property you're trying to purchase, you just got to try to do it maybe once. And then you can just deploy that capital to every property that you want to find. So that's, I like that. It's pretty cool.
Yeah, I actually had to create 2 calculators, right? One for, I call it the JV Elite Forecaster, right? So you're still going to underwrite these deals using a syndication calculator, right? But you're not going to do like the 70-30 split with it, because your fund is going to determine what those returns look like anyways. So if you want to underwrite those deals for the 70-30 split individually and see if they map out, great. And then go ahead and push it to 100. That by underwriting at the 70-30 split on the deal level will give you an idea if your fund will make money. But then once you know that the fund will make money, say it's giving off like eight pref or whatever it's giving off. I mean, it's meaning like 10% cash on cash return, 8% cash on cash return. You can go ahead and put it in at 100 and now map it to the fund. So I started a calculator that'll do one for just fund of funds, and then one for just JV opportunities. I'm trying to find the time to go ahead and marry the two, so we can just sell one calculator and then put it in as, oh, if it's a fund to fund, it'll go in this bucket. If it's a JV opportunity, it'll go here. So instead of having 2 type of calculators doing the same thing for you. So yeah, so I had to really reverse engineer that and think through that process, and then figure out, hey, I want everything, all my investments on one page, and be able to go ahead and see how it would perform with the fund. So it's starting to become a common practice right now. And man, I see a lot of people already that are interested. If you raise capital already and people are out there raising capital, I don't see why you wouldn't raise your own capital, because here's what it does. Sometimes when you're raising capital for these other big syndicators or other groups or other partners in general, some companies going to have to manage all their investors, right?
Right.
To shield your investors from other people, because you don't want your investors to be poached by other people. You got to raise a fund and invest with the fund, and now you report back to the fund like that. Right. You report to your fund. So right. I think it's a cleaner way to raise capital. It's more expensive, yes, but it saves you the time, because you're putting in all the work anyways to go and find your investors, network, have these conversations, and then raise this capital just to hand them off at the end of the day. It doesn't make sense to me.
Got you.
Hey, John.
Yeah.
So just a question. The return on the fund, does the return come before the investment is determined? Or does the return change? Like, you were giving an example of, somebody wants to invest $100,000, but the first call might be a quarter of that, 25,000. So, and that's because you found the deal. Now that deal is underwritten and it's going to, provide some kind of a return. When people invest in the fund, do they already know what the return's going to be? Or is it dependent upon the different deals that come in?
Can you see my screen right now?
Yeah.
Yes.
Matter of fact, I'm going to do one more thing. Make it big enough so you can see.
Yeah.
Oh,
that's
yeah.
good.
So I designed it literally so I can go ahead and copy and paste this out and say, hey, this is what I'm projecting for the fund. Now, this is what I'm saying the fund is going to do 8 pref. You can see that I'm not touching the 8 pref. I am in year 3, in year 4, in year 5. And that traditionally is a value add play. Value add plays never pay pref day 1. And a lot of people are over raising to just give you a return of your capital back as part of the pref going forward. So this is pretty consistent with my type of deals that I'm finding and the way I want to model my type of deals. So you can see I'm doubling the capital through the life of the meeting basically on average my cash on cash return. And this is only 3 investments at $3 million taken down at $1 million a piece. So you could see that my fund is set up to give my investors 8%. And then we're going to split anything above 8, 70, 30. And that's it. Now your investors, my LPs, are here. And this is basically all the LPs' performance of the fund. And I can break it down to an individual investor right here and say, hey, Gary, you want to throw 50,000 into the deal? That's what it looks like.
Right.
Oh,
Now,
okay.
That's 500,000. Sorry.
yeah, we get that. So let me ask you this then, John. If you're investing in the fund and you purchase multiple properties, I'm guessing that you can take all that depreciation, which is going to be a lot more than you might get in just one property, push that down to the investors.
Absolutely. It's just like a syndication, right? So
Right.
what we're doing is we're going to gather 5K. We're going to gather these 3 K1s, right? And that's another benefit to that too, is because you're investing in the fund, you're getting 1 K1, but all these three properties are part of that. So yes, we are passing on the tax benefits to the investors because that's one of the major factors of why people invest in real estate.
Cool. So is it just say
Oh,
out of that
your
fund-
accountant's handling that.
Right.
Yeah. That's why we have a accountant for my accountant. He's well versed in real estate. He does all my stuff. He's actually a partner with me on my 62 unit. And he understands that we'd be doing each investment would be doing a cost seg, but we'd be reporting it down and trickling it down to the investors through the fund.
That's very cool.
So John, if you start a fund and you're going to raise $2 million, is there like a timeline that you give your investors that, because obviously you don't have a deal in hand, you're raising money to go out find deals. What if you don't find a deal in a certain amount of time? Is there like a timeline saying we might stop this fund if there's nothing found and that fits this model that I'm looking for at a certain point?
That's a great question.
What's the safety net?
Yeah, that's a great question. You can always put in your documents that if we do not find, let's say we don't find a deal in 3 months of our allocated window because maybe whatever reason why you can't find a deal,
Mhm.
right? You can say,
COVID.
hey, I know someone that has a fund, a $1 million fund that is paying 1% to their investors on unused capital. That's basically the bank. You know what I mean? So whatever the money is doing in the bank account sitting, because he's collecting it as he gets it, which I think is a more efficient way, because if you have to do a call down, I don't want to call down to Jamie and say, I used you earlier, Jamie. I'm just going to pick on you.
There you go.
Jamie, I found an investment for the additional 25% remaining of your investment. You're gonna be like, well, I already used that, John. I don't have it. I don't want to risk that. I'd rather have it all up front and pay that 1% if I don't do anything. So that's kind of where it is, where I stand with that. So there's different ways to look at it. You can,
Yeah.
everything's could be added in your PPM or whatever it is. So if you got unused capital in your fund, you're only using, paying 1% on it. You can implement that on your PPM. That's a great question.
Yeah. So there's a lot of flexibility. It sounds like it's really up to you, the person making the fund, how you want to do it.
Yeah, absolutely. You got to protect yourself as well as your investors, because you don't want to pay 8% on unused capital.
Right.
Doesn't make sense. And your investors obviously got to understand that as well. But you can pay the 1% on the to the investors if it's building interest in a bank account. If you got a 1 million in a bank account, you're going to get some sort of interest. So you just give that back to the investors.
Interesting. That's really cool.
Also,
So,
what a few people do is they find bank accounts that probably give, 1.5. I don't know if you're going to find anything giving 2% with capital like that. If you feel like that's going to be an issue, find that type of an account.
right. Ahead of time. That makes sense. And
Also, I think I got one more thing on it. Also, a good thing is too, if you have let's say a $2 million fund, John, you can go to a bank and say, can I get a line of credit on this fund? So that's another added pro to that too. So you can get a line of credit. Let's say they want to give you $100,000 line of credit on that. So if you are drawing capital as a call down practice, let's say you have already exhausted that and you go to the bank and you say, hey, I have this fund, I want a line of credit on it. And now you got fund 2 coming along, but you haven't even raised capital on it yet, but you're going to raise capital on it. And you're coming across some investments, you can go ahead and start raising capital for your fund, use your line of credit to do some earnest capital for certain deals, raise that capital, and then go ahead and pay off that line of credit as you start getting in capital, your funds in. That's what my mentor does right now. He has I believe he has like a $500,000 line of credit.
Huh. That's pretty cool. There's definitely a lot of flexibility there. It's pretty, so let me ask you then, when did you start kind of going towards this path? Maybe like 6 months ago, 8 months ago, with fund driven more, and then so just kind of your typical syndication?
I joined a mastermind and it just made sense because my buddy who started the mastermind came off the mastermind before that. So this was like his second session mastermind with a new group. And we were just talking. It was like, yeah, a couple guys in the other group. It was more like a session for them. And they kind of went together on a partnership, on a subscription for one of those Preqin models together. And they started exploring, reaching out to institutional funds, institutional capital to raise like a $3 million fund or something like that. So what they did was they had all these discussions about funds, and it just kind of piqued my interest. And I just started, I don't know, diving into it. So that was at the beginning of the year during COVID. So I think I spent the whole 2020 learning about funds. I signed up for one of those like Marcus and Millichap, like market insights. I usually almost, for some reason, I oh my gosh, sending messages. So for some reason, I signed up for this thing. It was in the middle of COVID. It was just something to do. And I just met someone there who already works with funds, and he just was so gracious to give me some time during the session. So he came off the panel. He was part of the panel. He came off the panel, and I do what I do best. I just peppered him with questions. And he's like, "You're asking all these questions. What do you do?" And I was like, "Well, I do a few syndications and this and that, blah blah blah." And they're like, "Interesting. All right, cool." So find out he's from Boston. He moved to Florida and he lives out in Florida and he raises all this capital. His first fund was a $10 million fund, then went to a $30 million fund, and then went to a $100 million fund, and now he's raising on a $400 million fund.
Wow.
And he's like, "It's a lot of phone calls. It's a lot of work. Look at RAI firms or RIA firms, call them and ask them if they're looking at alternative investments, and start having those conversations, start exploring, start going to the conferences and having those type of conversations with them." And then I was asking them like very, very nitpicky things about, not nitpicky, but like specific, like, how are you managing returns? How are you projecting returns? How are you structuring them? Just little conversations like that. And what I do is when I get them on the phone, we just go, because we can just both go. But when it's on email, I ask him one question at a time, something quick, boom, because I know he's raising capital. So I'm very respectful of his time. I set up ahead of time. I actually have a podcast with him coming out soon. He's very, very, he has like good practices that he tells me all the time. He goes, "Go to my website, steal it, steal everything you see on there, steal the information. And if you're good at implementing things, steal things that you like from other people and implement it and go, because that's how you build your business."
Yeah,
But yeah,
I've heard that. before.
I got involved with it about a year ago, and I love it.
Yeah, I've heard people say that if you see something that you think you can do, but even if you can do it better, then do it. There's always a way to improve. I've learned a lot in the last couple of years of being around syndicators, and I've learned some pretty cool methods for lots of different things. Yeah, so I mean, I was just actually, that was going to be one of my questions to you is, how in 2020 have you had to modify your business due to COVID? And you kind of answered some of it, but
Another thing too is where there was a lot of SEC coming down on certain
yeah,
groups for malpractice of capital raising, and it was almost like if you're a registered broker or something like that, you can raise capital, get a fee for it, and go away or whatever it is. But it felt like that they were starting to target groups where that they knew that they were raising a lot of capital, but had a bunch of people in the GP. So I said, you know what? I got a family to protect. I'm trying to do this the right way. Fund model is the best way. How come people are not talking about this more? So I started going on every podcast and screaming about it. So I think the first podcast I probably ever did, if I ever go back and listen to it, I probably sound foolish, but hey, you got to start somewhere, because now the amount of information I know about funds, because I'm just comparing myself from here then to now.
sure.
I'm just saying I think I sound foolish, but I probably sound very, novice, but informative. But now I feel like I can give. You asked me a question, I probably already asked it and got the answer 7 times.
Oh yeah, I could relate to that just in real estate in general. I mean, 2 or 3 years ago, I didn't really know anything about doing this, so I know exactly what you're talking about. You have to ask questions, and just and that's how you grow and learn. It's great. Speaking of that, if anybody wants to ask any questions, feel free and ask them.
Well, I had a quick question. Did you mention assuming debt? Are you a fan of assuming large amounts of, if a deal is kind of out of reach, but it has assumable mortgages, even at a slightly higher rate than you would want?
Right now, everybody's assuming debt. A lot of groups, apartment wise, bought with yield maintenance.
Yeah.
Yield maintenance is expensive to pay. So what they're doing now is for instance, something came across my desk today in Florida, 2 package deal. You got to buy this one. They want you to buy that one. It's assumable for 3.6. And that's the way deals are going right now because no one wants to pay those prepayment penalties. And even if you said, nah, I want to buy them outright, they're probably going to push back on you and say, hey, can you assume this? And you got to be able to be qualified from that if you're going agency. So the agency is going to underwrite you. They're going to make sure that you are qualified. You got to have a strong KP. Also, if you are going to assume it, which is very favorable right now, the best part about assuming debt right now, if you're going ahead and bringing in new debt, there's a lot of COVID reserves that you got to start bringing to the table. So you got to raise more capital. When you're assuming, it avoids the COVID reserves.
Yeah. Yeah, no, that's a very good point. There's still those requirements for COVID, 12 months or 18, depending on what you're using. So you got to raise that much more to keep those reserves.
They went from 9 to 12 and I think right to 18. It's crazy.
Yeah, it is. Yeah. Does anybody else have any other questions?
Hey, John, it's Joe Janowski.
Hey, Joe.
How are you? I have a financing and a brokerage background, but one thing that you said earlier that piqued my interest was, when you've got the first fund set up and you haven't fully established the second, and you want to, go to the bank and get a line of credit. I assume, having been a banker, that they want to secure that. Were you suggesting using the funds that you haven't put to work in the first fund as collateral for the line of credit to go towards the second?
Well, you're going to be able to talk about that with the bank as well. So I'm still learning about that too, but you being a banker, you probably could tell me more. You're probably going to use it on the unused funds, and maybe you want to do it early in the fund where you already have the capital and unused capital. You want to go ahead and apply for some of those lines of credits. So a lot of hedge funds already do it. They get lines of credit. I'm reading a great book by the guy who started Blackstone. I don't know if you guys know him. I think his name is James Schwartzman. He references the line of credits. I know my mentor uses a line of credit. That's something I got to dive with him. I can't really tell you exactly how you go get it, but I know you can apply for one and have it because you have one of these funds. It's probably using the fund as collateral. Yes.
Interesting. So I have to ask you this: if you had to start all over today, knowing what you know now, maybe what are like 2 or 3 tips you think you would give someone in this field?
Just start. Just start. Talk to as many people as possible. My goal for this year is I'm trying to talk to anybody and everybody, and my goal is to try to be the best network I can be, because I did it all through high school and I needed to get back to that because it helps me feel like in touch with people. So if I can have a conversation with you guys here and then I come across another group and I say, hey, Joe, you might want to go meet, you might want to go, introduce, you might be interested in me introducing you to Henry over here, because Henry has some sort of a similar background to you. And I think it would be good for you guys to get connected to each other. And you never know, man, it's not that I want to be the matchmaker. It's just I've always naturally done it with my friends. And I still kind of pair people together, and not in a matter of like go and be partners or anything. But I feel like I have a good sense of fits and what maybe your business could use, or maybe a simple conversation. Jamie said, and I'm like, oh yeah, I have a guy for that. I can connect you with that. Or maybe Jamie has a guy, and it's always being able to find out who does what. So one, I can expand my network and be like, okay, if I ever needed this, I know I can ask that question too. I ask a lot of questions. So Joe, I might reach out to you and ask you some banker questions.
Anytime.
Appreciate you, bud.
Yeah, no, building teams and just networking, that's definitely one thing that I learned you have to do pretty early and just pretty consistently. And it totally pays off. You're absolutely right about that.
Yeah,
Um,
absolutely. And I think one thing going back to Joe's question is if I was going to dissolve Fund 1 and have Fund 2, I definitely probably have to notify the bank and let them know that, hey, this fund is actually bigger than the other one. So I don't know if the bank will have any issues with that, but I know I have to let them know because it's similar to, I would say, I would kind of equate it to if you're going to go refinance your house and you got a lock on it, you got to notify them that you're doing that, right? I'm assuming, but I don't know how that parallels with that correctly, but it just
Yeah,
makes
no,
sense that you got to let them know.
I think there's a parallel. And what I was thinking is if somehow something happened with the line of credit and well, getting the second fund off the ground, and
Well,
you'd already pledged the excess funds from, from the first fund. The folks in first fund know nothing about two, and two doesn't know anything about one.
well, usually if you're rolling out Fund 2,
Mhm.
you're probably already telling the investors you're rolling out Fund 2.
You may, but isn't it a distinct legal entity, separate entity?
Fund 2,
Yeah.
if I got two funds and you wanted to invest in both of them, don't you think you're going to invest in both of them?
Oh, absolutely. I'm just wondering if to pledge the unused funds from one as
Oh,
collateral
okay. Yeah.
to, that have to get the consent of the investors
Yeah.
in one to do that.
I see what you're saying now. Yes. I believe so because so you're saying if I have $100,000 line of credit, I have to keep $100,000 in my fund if I want to use the line of credit, right?
No, I'm saying that you need to offer the creditor, the lender, something, collateral that doesn't, that's not already tied up.
Yeah. I think I'm catching on to you. So you're
Well,
saying I can't have,
it'd be like owning a two-family house in Boston and being short on the down payment, and then saying to the seller, hey, I'll give you, a second mortgage on this property over here. And the lender says, the first lender says, what are you doing? You can't put additional
yes.
financing on my
Yeah.
property.
Yeah. I see what you're saying. Yeah. So yeah, that's just a conversation you have to have with the bank and whether
And
they're willing to give you that line of credit on that. Yeah.
that in your attorney.
Yeah, absolutely. And the thing is, what I was just trying to say is it's possible, basically.
yeah, right.
It's
Yeah.
definitely possible. They do it all the time.
Right.
Yep. And,
Well,
and
like every document, some things strictly prohibit it, and other things are silent, and you're free to do what you want.
and I'm curious, and you have my, yeah, I got a question now that I'm going to go ahead and follow. And yeah, I'm going to go and ask that question. All right. Yeah. I'm going to ask my mentor about that process and if they ever have to provide any of the equity to that line of credit if the event that they were never able to be able to for the fund. So
Mhm.
I'm curious to know that now. So I love this. I love this that you brought that up, Joe.
Well, I mean, that's what the cool part about it is that it's just the flexibility to do so many different things in real estate in general. And that's just another example of way people are just be able to be resourceful. It's another tool, really, I think about it. It's just really cool.
I think the best part about it is if you kind of do, you can actually do a 50-50, or you can say, I'm allocate 25% of the fund to a fund of funds, meaning investing as an LP, and 75% I'm going to take down my own deals, or the fund is going to take down deals. The best part of that is if you are starting to learn about mobile home parks or self-storage or whatever else, the best way to learn is investing as an LP, and investing as an LP with that 25% and whatever direction you decide to go in real estate with it. As long as your documents are structured accordingly, saying maybe it's just commercial real estate, you can just say it's all commercial real estate. Now you know, even though your focus is multifamily, you're going to start diving in and dabbling into a little bit of other things and expanding your type and really starting to diversify within other real estate aspects, as far as just not just diversifying location wise, you get to diversify asset wise. So that's kind of another neat aspect of it, of being able to keep it a fund of funds, or keeping it a blend of two, or keeping it all just, I'm just going to take down my own opportunities.
Yeah, that's very true. I have observed that in the last 12 months or so, syndicators that kind of were very particular to just multifamily, and now you've seen them making offerings for storage. They're making offerings for different types of things now. So I could definitely see how that's very, very relevant.
Yeah,
Well,
I know
wanna-
John and Gary are strictly, and Jamie, I know you guys are probably like strictly multifamily, but we're always around so many other people that, man, they do mobile home, they do self-storage. I'm interested in self-storage because it's just the unique ways, but I'm not there yet.
Right.
And I know where my bread is buttered, and I'm good where I am right now. When I start exploring that opportunity, it'll be basically when I'm ready to go ahead. When I feel like I got everything organized on a system here, hiring a few people here, hiring a few people there. Now I want those people to go ahead and go and be in place to go ahead, and you look straight at self-storage, look at mobile works, and now we get to branch out that way. I want to do it right when I'm doing it, but right now my bread and butter is multifamily.
John, do you know anybody in your network that's doing the self-storage now?
That is what is really hard to hear.
Yeah, get a little closer, Alex.
Do you know anybody that's doing self-storage now in your network?
Yeah, absolutely. One of my limited partners purchased her first self-storage because she got out a great deal, and she's running it efficiently, and she's looking at one.
Nice.
Yeah. She's doing well with it. Yeah.
I got a quick question for you, John. Now you've been talking about your fund and starting a first one. Have you actually started doing any kind of raising a capital? Or is it something you got a certain amount of time before you actually start doing your first fund?
I've just been talking about it with my attorneys, drawing up the documents. I have plans. I have plans for it. Yes, I do want to go ahead and do some. Obviously, yes, I'm going to be doing one. Yes, but it's when I don't know yet. I'm still structuring it to see if it's going to be 506C, 506B. I have an opportunity right now that me and a buddy of mine, we're going to partner on something. He already has a blind pool set up, so I'm going to be a part of that and helping him get off the ground with that. And his fund is not to be as a fund. It's just going to be go ahead and taking down multifamily assets. So the best part of that is being able to have the capital on hand. It's just going to be a small 1 to 3. It's either going to be a $3 fund. So the best part about that is being able to just, as you're raising capital, you can go ahead and take down deals. So I'll give you an example. As Dylan, who I spoke to today, is raising a $10 million fund, and he's already raised 3.6, and he's continuing to raise on that. But with that 3.6, he's already taken down 2 mobile home parks. So you can see that 3.6 got 2, another 3.6 get another 2, let's say, and then he'll get 1 more after that. So well diversified in that fund at 5 investments. So I rather have, here's the benefits of that. So if I'm in 5 opportunities based off of 1 fund, and this one is not performing well, I still got the strength of the other 4. So that's basically the best part.
Right.
And if you're doing that with the syndication, with the one, not that it's wrong, but if you're doing 1 deal and then that goes sour, you only waited off that 1 deal. That's That's the difference.
Okay.
Appreciate it, John.
Yeah, thanks. I
No
really
worries.
appreciate you jumping on and showing us this. It's really interesting to view it this way, and I actually haven't looked at it that way, so it was very helpful.
No, I appreciate that, man. I feel like every time I mention fun to people and I explain it and dive into it, they start to feel the same way you do.
Yeah. Yeah. Well, I think in this business, anything that's flexible help you kind of reach your goals. And this is just another method of being able to utilize that. So it's really great. Thanks for sharing. I really appreciate your time.
No, thank you. My goal is at the end of the day is to make sure people are creating a firm that they can actually scale and grow, and it'll help them, change people's lives. So if I can help them, teach them how I think is the best way to raise capital, is I'm not going to teach you how to raise capital. I think you raise capital with your network. And, if you're out there on social media and you got, I personally think it starts in-house first, right? So if you have a great idea, your friends and family are going to probably invest in it first. And watch Shark Tank. How did you raise the money first? Oh, friends and family. We went to friends and family. Like, it always starts that way.
Yeah.
So raise money, friends and family, and go put it to work and prove the model. Or the best way to do it too is you start using all your capital invested in things, and you just talk about it. Just talk about it. Just talk about it. And the next thing you know, people are like, hey, you think I can invest with you? Think I can do something with you one day? And then all of a sudden you're raising capital. You're not even knowing it. And that's how it works. It's just a lot of people put it in their head that raising capital is like, oh, I got to go and talk to like this banker or something like that. Or
Right.
just talk to your friends and family. It
Yeah.
starts there. The way you can talk to them about it. And this is the way this is one of the things too. If I can, like when I'm doing the podcast, I explain things like I'm talking to a child, because if you can teach a child something, you can teach anybody something.
Right.
Because kids, like the way they learn, that sometimes you got to break it down. And the reason why I do that is because I got an IT background, and my boss always said, John, assume that they don't understand technical jargon.
Yes.
So I say, all right, so I use a lot of examples and say you're doing whatever.
Yep.
Again,
I'm in IT. I know exactly what you're talking about.
You can't talk to them and like,
Oh.
The throughput, and the bandwidth, and blah. They're like, what? I'm like, well,
What?
the amount of space it got to travel through. All right.
Yeah.
How wide is it? You're good. So.
Yeah.
John,
Well, I want to be respectful.
Appreciate you taking the time.
Appreciate it.
Now, just before I go, we're not missing any questions out of the chat, right? I didn't have it up.
No, I think people are just putting in their little info. Yeah, nobody had any questions in here, so I should be okay right there.
I appreciate you guys' time.
That's a
Gary,
great
John,
presentation, John. Thank you.
we'll talk anytime you guys want. You guys already know.
Absolutely.
One nugget that I always leave you guys with is, and I learned this on the 62 unit, is we got 3 buildings. So what you do is you got 3 roofs to do. Do you hire one team to do it? All 3. In the beginning, you'll say, yeah, you do that. You source out, maybe get the guy that's maybe even not even the most expensive. All right, cool. Here's what you do. You got 3 roofs. You hire 2 different companies. Doesn't have to be the most expensive. Doesn't have to be the cheapest. Hire the two companies. Give you 2 different quotes, or they're probably close in range. Hire both of them. Reason why is you tell them whoever does the best job wins the last roof. And I'll leave you with that. Both of the roofs will be the best roofs ever. Always remember that. Hire 2, and if you got a lot of work to do, hire 2 crews. Get it done quick.
Yeah, that's good advice. Thanks. I really appreciate that, John. Thanks for jumping on and sharing us your wisdom.
No worries. Feel free to reach out to me anytime, guys. Appreciate
Thanks,
you.
John.
Be well. God bless. Happy New Year.
All right.
Yeah, happy New Year, everybody. Take care. Bye, everyone.
See ya.
Yep.
Bye.